we'll use Keith and Shauna, or we might even change Keith's name to Joe, because that's what I put on the slide up here. So let's pretend we've got a 30-year-old and we wanted to go buy some whole life, cash value life insurance, and we wanted to buy $250,000 on Keith or Joe. And if we did that, it would be $178 a month right now. That's according to research our firm just did with the top 5 whole life insurance companies out there. A $250,000 policy on a 30-year-old Keith would be, or a 30-year-old Joe, would be $178 a month. Now what happens is that over time it builds up inside of it this savings program called cash value. Have you ever heard of that? Say yes. Now, the actual averages of the top 5 companies are that at age 50, that Joe would have $34,000 cash value in there. That if he wanted to cash the policy out, they would hand him that. It's got a savings element to this as well. And of course, at age 70, he wanted to retire. He could cash it out. He'd have $124,000 there set aside. Now, that's pretty cool. And that's the way they sell it. You pay that your whole life. And at the end of your life, you got some savings. If you die, you've got coverage. And that's basically the way it's sold. They talk about this owning a house where term insurance is renting. And that's how the whole life insurance agents sell this stuff. Now, let's instead look for a second at a better idea. Let's say that we wanted to buy $250,000 worth of 20-year level term on Keith or on Joe. At 30 years old, that would be $13 a month for the same amount of life insurance instead of $178 a month. See what I meant by it's more expensive? Which means if I'm going to spend $178, I've got $165 left over to put into something else. Let's put that in a Roth IRA, way away from life insurance people, in a good growth stock mutual fund over here. And let's see what happens. Ends up $164,000, not $34,000 at age 50. Ends up almost $2 million versus $124,000 at age 70. Now let's see. $2 million, $125,000. Pick the big number. I'm spending $178 both ways. I got the same insurance and I got a bazillion more dollars. Now here's the big deal. Here's the reason this is the biggest ripoff since the payday loan. Payday lenders take advantage of the lower class. Whole life insurance is the payday lender of the middle class. Here's the problem. Let's say that we're trucking along there with the whole life insurance paying $178 for $250,000 worth of coverage. At age 50, there's $34,000 in savings, and we paid extra to get that. We see that now very clearly because we could have bought that amount of insurance for $13. So we know we've paid to build this, and we can actually run a rate of return, and we'll find out then that $34,000 is based on about a 3% rate of return, which is a lousy rate of return on the long haul. Here's the biggest problem with the whole thing, though, the ripoff of ripoffs. If something happens, he dies, they're going to send his beneficiary $250,000. What happened to the $34,000 he's been saving up all this time? They keep it. So you have a savings account with a horrible rate of return, and when you die, they keep your money. This is stupid. And yet it's sold like crazy. You know why it's sold like crazy? Because insurance agents are paid on premium. Their commission is calculated based on the premium. What do you want to sell if you're selling premium? 178 or 13? They sell the big one. Let's go all the way to the best and see what happens. Let's see what really happens here. Let's get $500,000 worth of coverage. Because here's the situation. With Keith down here, Shauna's got 2 little babies, right? Something happens to Keith, she doesn't need $250,000. That'll be gone just like that, won't it? We need to replace his income. If that's an average family, they're probably above average, but if that's an average family, then he makes about $50,000 a year. And if you had 10 times your income on you, or $500,000, we give Shauna $500,000 if something happens to Keith, and then guess what? She can invest that at 10%. If she made 10% rate of return on her investment, well, 10% of $500,000 is $50,000. Keith, I'm sorry, you've just been replaced. And you don't want to get too much because then you have to sleep with one eye open. So the best thing you can do is let's go ahead and get the proper amount of coverage so that little family's taken care of if something happens. Get that $500,000. It's only $21 a month. That lowers the amount out of our $178 formula that we've got, so our investments are a little less, but we still got almost $2 million versus $125,000 at retirement with what we didn't spend on rip-off cash value insurance. And that's what we're facing here. So never buy cash value insurance. It is not a good idea. People buy this stuff as an investment. It is not a good investment. We've just proven that. We've just broken it down for you very clearly. I don't own any of it. I've never sold any of it. I can't stand the stuff. Term life insurance is the only life insurance that you should buy. Now, why not use life insurance for investments? We just walked through it. Let's walk through it one more time. The returns are historically low. When you die with cash value, the insurance keeps the cash value. Well, with variable life, you make a little more on that, Dave. That's going into mutual funds. They showed me the mutual funds. They're earning 12 or 13%. Yes, they're earning that, but the net payout to you is never anywhere near that on your cash value growth in a variable life. Because what happens in a variable life is anytime you walk anything down the hallway of a life insurance company, its pocket gets picked while it's going. Because they're going to fee. It looks like a French poodle. There's so many fees. And by the time they do that, your net rate of return is very, very, very low.